The Dow Jones plunged by 1,276 points today. That's a move of just under 4%. It's the biggest point drop in the Dow since June of 2020, so it's been over 2 years. And of course, back in June of 2020, the market was getting hammered routinely because of COVID lockdowns. But what hammered it today was a higher than expected inflation number, which not only sent the Dow Jones tumbling, but pretty much everything else. The Russell 2000 also fell by about 4%, but the S&P 500 dropped by 4.3%, and the NASDAQ plunged 5.4%. Of course, the riskier stocks within the NASDAQ did even worse. If you look at the Cathie Wood Fund, down 6.8%. Of course, the riskiest asset of all, Bitcoin, got smoked. It dropped about 12% from its intraday high just before the CPI was released, when Bitcoin was trading just under 22,800, and by the time the market closed, it was barely holding on to a 20,000 handle for a 12% intraday drop. The Grayscale Bitcoin Trust held up a little bit better, but fell 10.6% on the day. Now, if you look at actual gold, it was only off about 1.3% on the day, although it was positive prior to the CPI. But gold at least managed to close above 1,700. It traded below it briefly, but it was above 1,730 before the number was released. In fact, gold had a rally Monday. Silver had an even bigger rally on Monday. It was up about 5% before giving back about 2%. So about 40% of those gains surrendered today. One of the bigger reversals, though, was in the US dollar index, which fell sharply on Monday. And then again on Tuesday morning, the dollar index was down at 107.68 prior to the release of the CPI. And then after we got that hot number, the dollar soared and we closed at 109.9. That's more than a 2-point intraday swing in the dollar index, and one of the biggest moves I've seen. The markets were preparing for a softer CPI. Everybody was under the impression that inflation had peaked and that it was coming down, and that when we got validation that inflation was coming down by the August CPI, that would take a lot of the pressure off the Fed, that it wouldn't have to raise rates as much because the inflation problem was solved. And so that's one of the reasons that the dollar sold off. It's one of the reasons that gold and silver rallied. In fact, it's one of the reasons that the stock market had been rallying, because the Fed was going to be taken out of the game. Maybe not completely sidelined, but at least it was going to tone down its rhetoric and maybe not raise rates as much as people thought. But now that we got this hotter than expected number, people think the Fed is going to raise rates more than they thought. In fact, not only is the market pricing in a 100% certainty that the September rate hike will be 75 basis points, but there's now about a 25% probability that the Fed's going to hike by 100 basis points in September. Now, I think the markets are wrong. I think the only way the Fed will hike by 100 basis points is if the market expects a 100 basis point hike. So as long as the markets are expecting 75, then that's what the Fed is going to deliver. But the markets still don't understand that even if the Fed hikes by 100 basis points, it's not going to bend this inflation curve. I don't know why everybody continues to be surprised when the inflation numbers come out worse than expected. They assume that what the Fed is doing is going to work. It's not going to work. The people who think it is don't understand the nature of the problem. As I've been saying since the beginning, since before people even recognized that inflation was a problem, that the solution includes positive real interest rates. That as long as we have interest rates below the inflation rate, even if they're higher, they're still negative, and negative interest rates put upward pressure on inflation. You can't fight inflation with negative interest rates. It's like saying I'm going to fight this fire by pouring gasoline on it. It's just that I'm only going to pour a little bit of gasoline, not as much gasoline as I was pouring on before. Well, if you're still throwing gasoline on a fire, that fire is still going to get bigger. And that is exactly what the Fed is doing. Let's look at the numbers that came out today for the August CPI. First of all, the headline number was supposed supposed to come out at minus 0.1%. And the reason for that was the big drop in energy prices that has been continuing thanks to the Biden administration's irresponsible depletion of our strategic petroleum reserves. But because we are flooding the oil markets with our strategic reserves, that is pushing down the price. But even falling oil prices weren't enough to offset other prices that were going up. And so we ended up with a positive print of 0.1 for the August CPI. But beneath the surface, it was even worse because the core number, which was supposed to rise by 0.3, rose by 0.6. That is double what had been estimated. And in fact, if you look at the consensus range of estimates, it went from a low of 0.1 to a high of 0.5. So above the upper range of expectations. And if you look at the year-over-year numbers, year-over-year headline CPI 8.3%, not as bad as the 8.5% in the rearview mirror from the prior month, but higher than the 8.1% that analysts had expected. But when it comes to core, that's where it's even worse. They were looking for 6.1% year-over-year gain. We got 6.3%, and that represents a significant increase over the 5.9% rise from the prior month. Believe it or not, though, after the CPI was released, President Biden made lemonade out of these lemons by once again pointing to the headline number and bragging about the fact that it was only up 0.1%. In fact, he said that over the last 2 months, prices are only up 0.1%. Because remember, last month in July, when the headline was 0, Biden was bragging that we had no inflation during the month of July, even though we had big increases in food prices and prices of other items. A decline in the price of gasoline masked the increase in other prices. But even though gasoline prices fell again in August, they're still very high. They're much higher than they were when Biden was elected, and people are still struggling with those high prices. It's just that they're not struggling quite as much in the months of August as they have in recent months, but the problem is they're struggling more with other prices that have increased by more than the price of gasoline has come down. Plus, nobody seems to be discussing the fact that increases in the CPI are cumulative, meaning that the year-over-year price increases in August 2022 are on top of the year-over-year price increases from August 2021. And if you go back and look at what the year-over-year price increase was a year ago, it was 5.3%. That's still a big number.